I buy the strong growth story. I understand the weakening in the housing market, but housing isn't what it used to be in terms of its impact on the economy, and it's kind of doing its own thing right now. It's not, I think, a leading indicator of a broad weakening. What we've got instead is a broad strengthening. Really, I think the only thing I would disagree with Steve is that I think the driver of the big boom in capital spending that we're seeing is not the tax cut, it's just the strength of earnings growth and the fact that we haven't done much capex for a very long time. So I think that keeps going, and I agree, 3% growth for the foreseeable future, that's putting the Fed in potentially quite a tricky situation, not because there's rampant inflation, that there really isn't, but because of the fear that if growth keeps going like this, we'll end up this time next year with unemployment heading below 3% and wage increases going crazy, and I think they have to keep hiking.
Guy, take that on.
Well, I would agree with that basic premise. The Federal Reserve is most likely to keep hiking for at least another few times. But I think the initial cracks in economic activity, particularly as mentioned a few other times, housing and specifically autos, are two sectors that are very consumer sensitive to the level of interest rates. And we as a culture have stopped buying a $30,000 car. We buy whatever it is, a $350 monthly payment. And that psychology, and considering how large a portion of consumption auto sales are for the U.S. economy, is really starting to show some of the negative feedback effects of higher rates already, even though the last 4 rate hikes haven't even made their way into consumer activity yet.
I wonder, though, and maybe, Joe, you interested in your response to this, the market kind of thought it could have its cake and eat it too, right? It could have the strong growth and not have higher rates along with it. So this is a situation where and having listened to Rick Santelli over so many years, the bonds seem to get into these ranges, right? So you get into this range. I think we're exploring the top end of the new range here.
But that's
and the market needs to get used to it and say, okay.
Is it that, or is this off to the races because we've been waiting and waiting and waiting for this to pick up?
But we're still tethered, though. We're still tethered.
Tethered to the central bank, you mean the central bank policy.
Tethered to German bonds.
Yeah.
Yeah, I think that we more make the market than take the market when it comes to interest rates. I think they attenuate
I would be
the
buying,
growth.
Wouldn't you be buying our 10-year versus anything in Europe?
Joe, one of the things that's really missed with the Bund Treasury spread is that the cost of hedging, if you're a German investor, of converting that into dollars and hedging, it blows away the entire yield differential. In fact, as of a few weeks ago, you'd actually had a higher yield in German bunds at 40-ish basis points than you would in treasuries at, what was it, 295, 305.
Does anybody think the price of oil is going to put the brakes on things?
I think it'll look, first of all, oil is a very different animal for the United States than it used to be. Higher oil prices, it may be
Should
either
be good,
a neutral,
but there's got to be a point at which it...
There's a break point, but I don't think we're there yet. But I just think that the market will get used to these new rates if it has the earnings growth and the economic growth to go along with it. If rates go up higher than growth would warrant, that's where the stock market's going to have a problem. And I think you have a bump here, but I don't know that you have higher levels in stocks all the time. Yeah. But I think the market can get used to this level because, and if the fundamentals do underlie it.